Hi, everyone. Welcome to the Timing Research Show for July 20th, 2015. My name is David Kosmeter. I'm the creator of Timing Research, and today we will be talking about the 95th weekly reports. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download it there. I have Dave Landry of DaveLandry.com hosting for me again today, so I'm going to go ahead and turn it over to him.
Okay, thank you, David Kosmeter, and thanks to TimingResearch.com for having me back once again. I've got a couple of veterans of the show this week. We got Jim Kenney of OptionProfessor.com and Ed Carlson of Seattle Technical Advisors.com. Jim, let's start with you. Based on, first of all, tell us a little bit about your trading and tell us a little bit about OptionProfessor.com for those of us who do not know you.
Okay, thanks, Dave. With regards to OptionProfessor.com, they have invited me many years ago to put together for them their DVDs, which are educational on option trading, going everything from the basics to the intermediate and advanced strategies. So those who are interested in learning more about the uses and risks of options, those are pretty handy to come by. I've been doing business in these markets for many, many years, and I try to look at things on both a technical and fundamental way. And later in the broadcast, as we go into things, I'll be able to outline some of the opinions that I have currently.
Okay, cool. Yeah, we'll get to that in 1 second. Looking forward to it. A lot of moving parts with options, so education, vitally important. All right, Ed. Ed's another veteran of the show, and Ed, you've done some interesting work over there, but I think you're probably better at telling us about it than I am. So go ahead.
Oh, thanks. Good morning, Dave, Jim,
Good morning.
Dave. Yeah, SeattleTechnicalAdvisors.com is a subscription-based research website which is focused solely on technical analysis. However, our niche or specialty, as you might call it, is the work of George Lindsay. For those who've never heard of Lindsay, you may have heard of his most famous pattern, Three Peaks in a Domed House. Lindsay was a market guru back anywhere from the 1950s to 1970s. Did his time on Wall Street Week with Louis Rukeyser, and wrote a newsletter for over 30 years, but never wrote a book. And so in order to preserve his methods, I've actually published 3 books on the work of George Lindsay. But that's what we're doing at Seattle Technical Advisors.
Cool. Cool stuff. Okay, let's start with the question of the week. In fact, let's go back to you, Jim. Based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower by the end of this week, and that's the close of the 24th? And once you let us know your prediction up or down, rate your confidence on a scale from 0 to 10, with 0 being no confidence and 10 being extremely confident.
Okay, well, basically, as far as the short term, obviously the next 4 days, that's a very rough racket, as I always say. So this is absolutely a guess. I'm concerned, I'm obviously concerned about some things going on out there, like the transports are still showing me sell signals, and the VIX is extremely low, which sometimes corresponds to a high point. And then the Russell isn't exactly got great legs here today. It's rolling over a little bit. So obviously those things are concerning. But you cannot deny, the strength in the NASDAQ. You cannot deny the momentum that's been picking up a little bit here. So if I was a guessing man, I would have to say higher until evidence turns around. And basically my confidence level would be, if 10 is great and 0 is no opinion, maybe I'd go with a 2 or something like that.
Oh, okay.
Something a little bit higher than 0, but certainly less than 10. I'm not a 10, that's for sure.
Well, every now and then we'll get a 10 on the show, and I'm like, wow. All right, Ed. Same bat channel, same bat question goes over to you. Higher or lower by the close on Friday, and rate your confidence on a scale of 0 to 10.
Well, I'm going to make your day, Dave. I'm going to say lower, and I'm going to have a confidence level of 10.
Wow!
Hey, somebody had to do it.
All right.
Usually I try and just kind of scoff over or gloss over my reasons, because I know none or very few of your listeners are acquainted with the methods I'm using. Again, the methods of Lindsay. But this time I'm going to throw out some terminology.
All right, go ahead.
We have middle section forecast from the basic cycle pointing to a high on July 13th, and a middle section forecast from the multiple cycle pointing to a high on July 21st. That's an unusually wide time range that I was looking for a high in. But we can narrow that down, and while admittedly my single date point forecast was for a high last Wednesday, today would not be out of the margin of error at all. As a matter of fact, it's right in the pocket of the time frame. As I said, 13th to the 21st, and I'm looking at that small cap index as well, like Jim, rolling over today, and I'm thinking today's the day, if not definitely tomorrow for the high, and then I see a pullback lasting about a week and a half.
Okay, we'll get you to elaborate on those few things. I agree with some of the things you're saying, especially that Russell's got me really concerned. Forgot to introduce myself, which is unusual. Normally you can't shut me up. For those of you who don't know me, Dave, my name is Dave Landry. My email is dave@davelandry.com. I'm Dave Landry of davelandry.com. I believe that you can only predict the short term when it comes to markets. A few people have confused that with you could always predict the short term, and I disagree with that. And I'm not really good at predicting the market as far as like the show is concerned, unless I have a setup. But once you have a setup with the longer term trend in place, then your chances are pretty good of predicting the short term. Now, you don't know if that longer term, if that forecast is going to pan out, but you could certainly use some money management to keep you in a position for a long, long time if it does. I have a 21-page report which explains pretty much all of that, which is about 95% of my methodology. So if you read that, you're well on your way, and you can check my website for that. There's a banner ad for free reports, or check the sidebar. All right, enough of that. I think the market, well, my prediction is I'm going to go with higher. And the reason I'm going to go with higher is when the market's in a longer-term trend and at or near new highs, you're better off to err on the side of the trend. And the other thing I've been using for quite a while is the 200-day moving average. And as long as we are above the 200-day moving average, and ideally you want to have some daylight, meaning that the lows are greater than the moving average, I'm going to go ahead and continue to err on the side of longer-term trend. Obviously, the Ps have been sideways, the S&P 500. For those who don't know my slang, I've been sideways for quite a while. But they're at new highs or just closing in on new highs, a little overbought. I guess we'll elaborate on some of these things in just a second. But so there's definitely some concerns out there. But as long as we're above that 200-day moving average, I'm going to err on the side of longer-term trend. What amazes me is that if a market is trending, everything works better with trends. So just something really simple like the 200-day moving average. Now, if it catches up to price and price starts chopping around it, then it no longer works so well. But for now, again, let's stick with that longer-term trend, and I'm going to give a confidence of a 6 on that, and then we'll flesh out. In fact, let's start that now with Jim. What developing events, they can be technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, I think you have to look at the globe, and the globe is going to have an effect on our market as far as, is this China with the police showing up at the regulator's office when it was down 30%? Is that creating a bounce that's going to last, or is the reality of the weakness there going to resume its to the downside? We've had a nice bounce because Greece got a loan to pay off the people that they owe money from the people that they owe money from. So, we'll have to. I want to get in that business. I want to owe somebody $100 billion, and then when they ask for their money, I say, "Well, I'll give you your money, but could you loan me the money first so I can give it back to you?" So anyway, these are news reports that have swung momentum quite a bit. And then, of course, you had the Google situation on Friday. Where it looks to me that could have been one of the massive blow-offs. We'll have to see if it can go right back up again. But the last time we had that kind of a big jump in the market in one issue was Cisco back in 2000, and Cisco was at $75 at that time. And today, if you look at your quote, 15 years later, it's trading at 28. So, a lot, what's going to be happening here is we're going to settle down with Europe and China. We're going to find out if that's for real or not. We're going to see more of the earnings coming out, which if they continue to surprise would be supportive. But if any of those other things turn sour a little bit and selling comes back in, like the gentleman was saying about rolling over to the downside in the next few days. That's very possible. Very possible.
Okay, gotcha. All right, Ed, let's go to you. Same question. What developing events, technical or fundamental, will be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Yeah, I'm not a big believer in fundamentals. It makes for great fodder for conversation, but I've got to stick with the boring, dry stuff, and that's the technicals.
Yeah.
I see this market as terribly overbought right now, and it may only be short-term overbought. I don't think so, but I have to allow for that possibility. But my metrics are all showing, or for the most part, are showing an overbought market that needs to pull back. One thing that could change my mind is if the McClellan oscillator could close over 150. It has not done that yet. The McClellans like to say that that is what do they call it? Escape velocity. If their oscillator gets over 150, and it doesn't mean the market's going to go straight up from there. It just means it's got the oomph behind it that you should expect that in the future. So I guess the McClellan oscillator is the one thing I'm watching right now for that would change my mind, my bearish mind.
Cool. A lot of the things you guys mentioned, I do ignore all news. I also ignore all fundamentals. I agree with you, Ed, when it comes to fundamentals. When you make a trade, you agree on price. You don't agree on PE. Oh, by the way, PE is the biggest, or the top component of that. The numerator is actually price, believe it or not. People don't even realize that. One of the most fundamental indicators out there has the price is the numerator. But yeah, you're agreeing on price. You can't go down to the bank when your stocks are half the price you used to be and tell the bank they're worth more or not. They're worth what they're worth. What's got me concerned is, well, first of all, again, S&P 500 right at new highs. Nasdaq Composite at new highs, 100 at new highs too. But the composite is what I tend to pay attention to. So those are good things, obviously. And again, I've got the distinction of being labeled a trend following moron, so I'm not going to try to outsmart it or fight it. I'm just going to stick with the trend until proven otherwise. I do not like the action in the Russell 2000, as both you guys have brought up. I fully agree with you. It's a little concerning. The thing about the Russell, though, volatility is a little higher. When it decides to kick it into gear, it could go 1%, 2%, 3% pretty quickly. So we'd be back to new highs. So that would be certainly a good thing. Semiconductors have me concerned. I try to avoid all news. It was kind of interesting the other day. I just had to take a peek when I saw Google up so much. And one of the commentators said that it looks like everybody in the world sold everything just so they could buy a Google. So that was kind of interesting. And on that day, the Russell was hit pretty hard. So obviously the broader market, or at least the market I like to watch, the smaller cap stocks, were being hit hard. I agree with both of you guys. We are overbought. The problem with overbought is overbought can always become more overbought if you're trading that mean reversion type of thing. So you kind of got to tread lightly with that. But again, I'm going to stay bullish, or I hate to even label myself. There's plenty enough to worry about. But as long as the market keeps going higher and can climb that wall of worry, I'm going to try to just close my eyes and stay long best I can. So, okay. Let's go to the question of the week, which is a familiar one. And Jim, we're going to go to you on the question. Let me get to it. Do you think? Actually, this is for the professionals in here. The second part. What do you think was the most important thing for becoming successful as a trader? And that's easy for me to say.
Well, it's always good to surround yourself with as many knowledgeable people as you can. So the bottom line is, whenever you get into any business, if you could hang around with very experienced people who've seen many different cycles, many different environments, and are very familiar with many different alternatives to each environment, then you're going to have a big menu of choices when you look at either a down, sideways, or up environment, and ergo you're going to have many different ways to skin the cat. Also, you want to know what your plan Bs are. So if you have things on the books, you would like to know how you could elegantly switch around and get back on the right side, and different tactics that only a guy who's traded for a long time might have at the tip of his tip of his tongue. So I think really experienced guys who've been through a lot of different environments, who are very familiar with a lot of different alternatives, learn from them, then do a little bit on the paper if you'd like, and see if these tactics can be employable, and then take it one step at a time.
Good advice. All right, Ed, let's go to you. Same question. What do you think was the most important thing for becoming successful?
Oh, I got to agree with Jim. However, I would not put that at the top of my list, just maybe number 2. For me, making the jump was finding one thing, and for me it was Lindsay, but it doesn't have to be Lindsay for anybody else or everybody else, and drilling down, going real deep, narrow and deep. I always think of, when I think of technical analysis, I always think of buying a suit. And you can buy a suit off the rack, or you can get that suit off the rack and then have it tailored. And you got to tailor this stuff to your own acclimation to fear and greed or whatever. But you got to go deep. You got to become an expert in whatever it is you're using. And usually that works. Figure it out and be the expert in whatever you're doing, and it'll usually take care of you.
Cool. Well, I can go on and on this, so let me try to keep it as short as possible, which is not going to be easy. You have to realize that there's 3 major aspects of trading that come up in virtually every one of these shows. It's your mind, it's your methodology, and it's your money management. And you cannot separate any one of those. I often do a webcast where I'll show like a 3-stranded rope with each one being one of the strands. And if you get better at one, you get better at the other. As I often say, money management will cure a multitude of sins. So if you're just trading at a small size, you can get your methodology right and wrap your head around your methodology, and you understand there's going to be losses with your methodology. The more you understand your methodology, the better off you're going to be. As a trend guy, when the market starts chopping sideways like it is now, sometimes I just have to sit on my hands and wait for a trend to develop, which maybe is beginning to develop as we speak, and that would be certainly a good thing. Where the psychology comes in is I've never met an unsuccessful paper trader, and that's provided, of course, you spend a little time at least studying the markets. Probably the biggest thing that I see with a lot of people is there's a lot of adages out there that they follow that are simply wrong, like tight stops must be used. Well, that's not true, because sometimes a market requires, when I say a market, I mean a volatile stock, requires a fairly wide stop. And many times people are going to get stopped out on every trade. So you have to fully understand how markets work. Stock selection can be very important. Make sure you're picking the best of the best stocks. I don't understand why these people who are very successful in their current or prior careers that focus on this perfection in their life, but they trade mediocre stocks. And sometimes it doesn't have to be that complicated. Just look, is it going up? Then yes, maybe look for a place to get on. But a lot of times I'll get charts that look like electrocardiograms that they have no tradable patterns. Keep it simple. It's amazing. Like I just said, everything works better with trends. Just seek out trends and look for places to get on board. Again, money management, money management, money management. Money management will cure the multitude of sins. And then, again, not to beat the dead horse, but just make sure you're doing something really simple. And I like what I think it was Jim brought up. He said you got to go through some cycles, and absolutely, you need to go through some up cycles, some down cycles, and some sideways cycles. Now, for me, I know Jim's into options. He's got something that'll work in all those markets, whereas for me, I just sit on my hands when it goes sideways, and I'm perfectly okay with that. I've learned to just stick with one methodology, perfected methodology, and just get better and better at it over the years. But you definitely need to live through a few cycles. I have people who will join my trading service and the market is going pretty much straight up, and they'll print money to a point where they'll quit jobs. And I'm like, guys, you can't, you got to go through a few cycles. And of course, a bear market comes along, and they don't know what hit them. And so you have to go through a few cycles, fully understand your methodology, have some money management in place to keep you in the game, and then the mind will come after that. It's kind of a chicken and a egg thing, but your mind will come in. Ed, I hear you rumbling over there. You have something you want to chime in on that?
No, that's not me.
Oh, that's not you. Okay, it must be Jim. Okay. Any other? Well, we've got a little time today. Any other thoughts from you guys on the psychology or money management or methodology? Go ahead, Ed.
Yeah, I was going to save this for the conclusion, but since you're asking for comments, let's see here. I had three things, and the first one, I'd like to hear Jim's comments on it, actually, but I'll go ahead and get all three out. Number one is, we had a strong rally last week, but my impression is that we usually see a change of trend in the market after option expiration, and of course that was last Friday. Right. That's another, arrow in the quiver for expecting a pullback this week. Another observation, I just wanted to kind of correct myself. I think I said earlier that my single date point forecast for a high was last Wednesday. And I should just remind everybody, or probably first time most of you have heard it, this Lindsay business that I use, it's for the Dow. And as a matter of fact, Lindsay specifically warned against trying to apply it to any index other than the Dow, except perhaps a more narrow blue chip index. And looking at the Dow, you can see that the high so far was actually last Thursday. So at this point, the forecast was only off by 1 day. So feeling pretty good about that, despite the fact that the S&P and NASDAQ, well, the S&P's at its old high, that NASDAQ made a new high. And that takes me to my third point, which is this is looking an awful lot like the bull market top in the year 2000, where the Dow made its top in January 14th, but 2 months later, the S&P and NASDAQ made their final highs. Well, that's what we've got. What I think is happening here, our final high in the Dow was May 19th, and here it is 2 months later, and the S&P and NASDAQ are making their final highs.
Okay. Jim, you want to jump in on that?
Yeah, well, a couple things. On the options, anybody who thinks it was just coincidental that the Google move happened on options expiration day must be a very silly person. Because some of them, and I'm sure the investigators are going to have plenty of tickets to go through, finding out who was long the July options for $100 that went to $3,500.
Yeah.
So there was another Gordon Gekko, buy me 1,500 of the Anacott steel. You know what I mean?
There you go.
Anyway, so yeah, I mean, obviously that was, I think that was a big squeeze of epic biblical proportions. Obviously it was the biggest run-up in history. That would put it as biblical, right?
Yeah.
So anyway, that's the story on that. The market to me is having a harder time making progress as far as percentage gain is concerned. So, I was measuring that Chinese market a few weeks back with you guys. You might not remember, but I was saying, we peaked out at 6,000 in China, and then it went to 5,000 area, then it popped back up to 5,800, and then when it broke the 5,000 area, we went all the way down to 2,000. So when we were getting that rally, that parabolic rally up towards $5 grand, 5,100, it's not an exact science to the penny. It's a ballpark county, right? So when you're in that county, I mean, that is where it should stop. And boy, did it stop. I mean, within, 3 weeks, we lost 30% of the value.
Yeah, you don't need as big a measuring stick anymore.
No. I mean, like I say, anybody who took any kind of position selling Chinese stocks, whether it be 4,900 or 5,100, was very happy within 3 weeks.
Yeah.
Now here, I'm using some moving averages on a long-term graph that come in 1980, 2000 area, coincidentally around the February lows. So as long as we stay above that, I'm not going to be getting fabulously bearish on this thing. But my personal view, my personal opinion is we're definitely in the fourth quarter here because coincidentally we have the election next year, and that is when the wheels have come off the bus in a very dramatic fashion in history to go along with an extended market and to go along with an interest rate environment that may very well change because the utility average, which is interest rate sensitive, has the 50-day and the 200-day crossing. So obviously people are selling out of utilities. Number two is the high yield. And the cross, right. And then you've got the high yield. You've got the high yield market that has lost about 20-30%. From the highs, and then you've even got the oil energy ones that are down like 60-70%, and then even the medical buildings and the REITs and the trusts that have to do with the medical area, they're down a good 20-25%. Which I don't know if that will be able to read into any of the medical stocks that have had a good time if they're going to start giving it up a little bit. But there's enough sobering here that makes me feel like we are getting into a final higher area, whether it be here or 2240 area on the S&P. But if I was a guessing man, between time getting closer to the election and the prices getting anywhere between here and 22.40, this might be a very good area for people to learn about hedging, which I'll talk about on my exit from the meeting here today.
Okay, cool. Yeah, you brought up some interesting points. It was kind of interesting with the China stocks. We were finding a tremendous amount of opportunity in lower-level Chinese stocks that just were coming flying off their lows and setting up as these emerging trend patterns. And I knew it was the proverbial "when pigs fly" signal, but who cares? You know, they were going up, and we did really well. We got stopped out. You just ride the trend until you get knocked out. That's kind of an interesting point. On every trade, it's going to end badly. It's kind of like buying a pet. You know it's going to end badly. But, you know, in between, it might work out okay. But, yeah, I fully agree with, like, the bonds. I totally forgot to say that earlier. Bonds have been in a down, headed down for a while, and then they're consolidating by going sideways. It's the delta in those rates, as you guys know, that's going to spook everyone. And there's always a lot to worry about. And obviously, as you brought up, Jim, energies and metals, and especially gold and silver, are just headed lower in here for now. So that's certainly another negative thing happening.
I wanted to just jump in here on the gold because I did notice that on the gold, you know, it went down about 40% off 1900 towards 1140, and it was holding that, even had a bounce back towards 1300. But about a month ago, Barrick Mines made new lows under 11, and now it's in the 7 area. And that was kind of a tip that somebody was giving up on gold. And now today we see the 1140 went bye-bye. So if it's going to go down towards 60%, you might be able to pick up gold if that happens between 7 and 800, and that might be a more interesting time to bite that apple.
Yeah. Oh no. I'm waiting. You know, I think it's a little late to short these areas, but I guess it's a trend follow. I shouldn't say that, but I think when they start bottoming out, it could definitely be worthwhile. But you don't want to catch a falling knife. I mean, look what gold did, and look at the rest of the metals and energies and all that just recently.
And it's not one last thing. One last thing about the gold. I just want to jump in. You know, if you want, you know, people have a why is it going here or there? You know, the dollar's been very, very strong. That's not going to help gold. And the printing of money that's going on is going into buying debt. Some of the debt, I think everyone knows, is going to be defaulted upon. So it's not as inflationary to print money and buy crappy debt, which is basically what they're doing. So that's why, if we remember not so long ago, when crappy debt called real estate loans, CMOs, went belly up, obviously that did not stimulate the prices of real estate. So there is some deflationary forces coming out of all this debt that's being created. Couple that with the strong dollar, and holding onto a metal that's not paying any yield, you know, is obviously not as attractive. You know, Jim,
you know, this brings us back to you have to live through a few cycles. And the world is a lot more complex than it seems on the surface. And I think your novices come in and think, oh, if the dollar goes up, it means this and it means that, or if they print money, and then you can connect all the dots. Well, you can connect the dots, but they're constantly moving, and you just have to follow the trends as they emerge. At least that's the way I play it. But yeah, it's a complex world, and things decouple for a while, and they inverse correlate, and you just have to pay attention to what's going on at all times, and of course watch everything. All right, Jim, while we have you, any closing thoughts? Any thoughts on the market, or any initial thoughts, and anything else you want to tell us about optionprofessor.com?
Well, closing thoughts would basically be, and I covered some of them, you know, just briefly on the prices of gold and of the interest rate situation that I'm seeing, and you know how the transportation average, you know, has rolled over and you know not made a new high since last November, so that's getting old as far as that high point is concerned. And then of course we're getting closer to where the election's going to happen, which historically has been a rough racket for the markets. And so, you know, again, I think looking forward, you know, having certain types of defensive positions, if you want to stay with the markets, is not an unwise thing to be aware of. So what I would like to do is invite everyone to the free seminar we're going to have on Thursday, and we'll send an invite out by email, and we'll cover hedging in detail on a few different angles, you know what I mean, not just buy puts, but a few different ways, and go over the use and the risk of the kind of tactic. And I think it'd be very helpful, maybe not today, maybe not tomorrow, but having that tactic in your holster at some point. You may want to shoot that bullet.
Cool. All right, Ed, let's go. Ed, let me a quick question real quick. With the Dow, with the transports headed lower, as Jim pointed out, does Does the Dow theory or the transport average, does it focus into your research at all, or is it just something you observe, or how do you factor that in, or not?
Oh, I keep an eye on it. I mean, it doesn't have anything to do with my Lindsay work, but
Right.
as far as technical analysis is concerned, sure, you bet. But I don't think we've gotten any Dow theory sell signal yet, and we won't until the industrials make a lower low. I'll tell you, more importantly to me, this as far as the transports are concerned, is just the fact that they're a cyclical. And always figure the cyclicals are going to lead the market. Like Jim was saying, I think, or you, Jim, I think, mentioned his concern with the semiconductors.
That was Dave.
That was Dave. Okay.
I'm not going to take Dave's music away from him. That's Dave.
You know that it's another cyclical, and you watch these things to try and figure out where the market's going. Before we leave gold, I thought I would mention that I'm looking for a cycle high in the dollar this Friday, which would mean we ought to be seeing some relief in gold and crude oil and commodities in general. My concern, however, is there's a big symmetrical triangle on the weekly or monthly chart in the dollar, which points to a minimum run to 102. And then I just actually published today a short column at TraderPlanet.com pointing out a cup and handle formation, which points to a minimum run to 101. And so, unless we see an explosion higher over this week, I don't think it's going to make it. So my question is, well, okay, so let's assume the cycle's right and we get a pullback. Is this the big pullback that I'm expecting for this summer into this fall, or is this just a stop on the way to a higher high? And I haven't quite figured that one out yet. I probably should have thrown that out earlier in the conversation to get some feedback from the two of you.
Is that the dollar or the overall market? I lost track.
I'm just talking about the dollar and commodities.
Oh, okay, cool. Yeah, it's kind of interesting. It looked like it was rolling over, but it came back. Jim, come to you. Sorry.
No, I was just going to say that in any of these markets, generally they're back and forth type markets, especially since you've got market makers going against retail business a lot and things like that. So they could easily come down and get everybody stopped out underneath 1140, take it all the way down to a certain number, and then of course when that volume dries up and there's no immediate sell volume right behind it, it can snap back under its own weight. So there's no doubt that back and forth action is always the most probable thing.
Yeah.
Gotcha.
Unless you're short Google Friday, that was the only.
Yeah.
Then parabolic moves are the norm.
And before I forget, you have any closing thoughts? Whatever, and then on SeattleTechnicalAdvisors.com.
Yeah, no, I guess I've given you my thoughts for the day. If anybody's interested in learning more about the Lindsay approach, you can always pick up what I call the July Lindsay report. It's a monthly report. You can get it at the website. Just go to SeattleTechnicalAdvisors.com and search the menu for Lindsay report, and it'll take you right there.
Okay, cool. To wrap things up on my end, DaveLandry.com. If you have any questions about anything today or anything else, Dave@DaveLandry.com. I answer all my emails with the caveat eventually. Again, I have a 21-page report. You can get that right off my homepage. I do a weekly webinar called The Week in Charts, and we have a lot of fun with that. I don't take myself too serious. I'll lecture about the markets for a little while, and then we'll take questions on trading. And then we look at the individual stock picks, and a lot of good stuff comes out. If I say so myself, as far as trading the trend methodology, and I'll point out when a chart looks like an electrocardiogram, which is helpful for many. And every several weeks, I do a nightly show where I'll go into IPOs or my trading methodology or something along those lines in a little more detail. And that's kind of a bit of a teaser, kind of an infomercial, but I usually put a lot of good information in those, so they're worth checking out. And all of this is on YouTube, by the way. My YouTube channel is youtube.com/C as in custom/Dave Landry. Okay, great show again this week, guys. I enjoyed, I enjoy both of you guys are on here. I often learn a lot, so I thank both you guys for being here. Jim Kenney of OptionProfessor.com and Ed Carlson of SeattleTechnicalAdvisors.com. David Kosmider, thanks to you once again. Thanks to Timing Research. And let me turn the show back over to you. Thank you.
All right. Thanks, guys. I just want to remind everyone who's watching that sometime later this week or next weekend before Sunday afternoon, be sure to go to TimingResearch.com/current survey to fill out the next survey and have your responses be part of next week's report. Join us next week for the show. Jason Jankowski of TheLionOnline.net and Thomas DeLello of BorderFlowEdge.com is going to be on. And I just want to thank my guests again who were on today. Jim Kenney of OptionProfessor.com, Ed Carlson of SeattleTechnicalAdvisors.com. Thanks for being on again, and Dave Landry of DaveLandry.com. Thanks for hosting again.
Thanks, David.
Thank you.
Thank you.